Okay, all right. So that's basically stuff we will get to in just a bit from now. But let's get you a global perspective. Ed Yardeni, president at Yardeni Research, is now joining us. Ed, good to have you with us here. Thank you very much. I was talking to someone here in India who's on the global KPO side, I mean, sort of knowledge providers to large US firms. And the feedback is that firms are in the US, large firms are tightening their belt quite aggressively, preparing for perhaps what is a very well advertised recession. It's coming. It's around the corner. Everyone is ready for it. How bad is it going to be? I think is the only question which remains.
Right.
Your thoughts, Ed? I mean, because this has got implications for markets, earnings, etc.
Well, I seem to be in a minority of economists and strategists who don't think we're going to have a recession this year after all. If we do have a recession, it'll be the most widely anticipated recession of all times. And I think we've already seen a lot of people and companies make adjustments so that they're just not vulnerable to having to scramble to suddenly move into recession mode. And meanwhile, the latest data continues to show that for all the talk of a recession back in 2022, the economy did quite well. Instead of a soft or a hard landing last year, there was no landing. Economic growth actually picked up in the second half of last year. I think that the economy is going to do quite well. I think it's very resilient. And I think we are going from the new normal of unconventionally easy monetary policies, which we had from 2009 to 2021, back to the old normal, where the economy can grow, inflation is somewhat higher than in the past, and interest rates are maybe between 3% and 4%. And I think that would be a good thing.
That's great. So after all that nervousness, excitement,
Yes.
finally the expectation is that there won't be any recession after all. Well, how do you see markets react? Because, I mean, it has been a very tumultuous time for global markets. Now, even back home in India, the market is sort of refusing to even react to good news. Do you think, if you believe that there's no recession coming, is this the time to go all in into markets like India?
Yeah, look, the problem with the idea of all in, it's not as though this market is going to go straight up. I think we did make a low in the bear market on October 12th of last year. I actually thought it was back in June that we made a low when we got to 3,666 on the S&P 500. But I was wrong, and it turned out that we went lower on October 12th, but it wasn't much lower. I think it was a retest, and ever since then, the market's been going up again. Now, in the previous rallies we've had in the bear market, the Fed came and slapped it all down. But this time around, I don't think the Fed's going to do much more than 75 basis points over the next few meetings at 25 basis point a shot. I think they're already where they want to be, and I think the economy can handle it. I'm very impressed with the behavior of the market when I look at the S&P 500 equal weighted as opposed to market cap weighted. On an equal weighted basis, since the bear market started or the bull market ended on January 3rd of last year, let me look at my numbers here. The S&P 500 is down 16.6% since the January 3rd, 2022 peak, but the equal weighted is down 8.4%. So we're really seeing a broadening of the bull market. But again, it's not as though stocks have gotten that's ridiculously cheap as they typically get in bear markets. They're kind of fairly valued. So I think we're in a stock picking market. Stock pickers, I think, are going to do better than momentum players.
All right. Morning, Ms. Yardeni. What about China? We just got some data around half hour or so ago. The retail sales contraction is not as much as expected. The Q4 GDP is better than expected. And the other data points as well that are coming in from there are fairly good. Yeah. What's your sense in China? This reopen is really playing out. Go ahead, sir.
Yeah. I think the reopening is probably working. It's sort of a tug of war between the virus and people just sick of being locked up and wanting to go to work, wanting to go out and spend money. And there's a tremendous amount of pent-up demand because of the lockdown, certainly of the past few months, if not the past 3 years. So I think China is going to recover. I don't think they're going into a recession. By the way, I don't think Europe's going to go into recession because the market forces work. The price of natural gas soared, and as a result, there was a tremendous amount of increase in production of gas that went to Europe. So Europe looks okay. China looks okay. India certainly looks fine. And the U.S. is doing, I think, will do relatively well. So contrary to what the World Bank is alarmed about, I don't think we're going to get a global recession. And I think a diversified global portfolio makes sense here.
No global recession, but global disinflation is here to stay, Ed, because that is required for markets, for stock markets
absolutely.
to do well.
That's absolutely required. I think we are seeing that, well, at least in the United States, we've seen that consumer goods price inflation has come down dramatically. Durable goods inflation is slightly negative on a year-over-year basis after being up something like 18% on a peak basis last year. So we are seeing consumer durables goods coming down. I think food and energy prices stay high, but I don't think they go up. I don't think they go down. So when you take the year over year, that's kind of no contribution to inflation. The issue is services, and everybody knows that in the United States we have a problem with rent inflation, and we know that current leases, new leases, are that inflation rate's coming down quite sharply. So the pandemic created all kinds of messy situations around the world, and I think we're still sorting out the impact of the pandemic, and as it sort of dissipates, I think we're getting back to normal.
Okay, well, I wonder what normal is, right? The meaning of the word normal has perhaps changed post-COVID. But you ended the last, statement by saying that a diversified portfolio, global portfolio, is the need of the hour. What do you mean by that? Do you raise your allocations to gold, to commodities? There are alternate asset classes which are back in action. What's the asset allocation strategy for the year?
Well, I tend to focus on stocks and bonds. Commodities are extremely volatile. They're hard to invest in other than through the stock market. Otherwise, you're in the futures markets or taking delivery of the product, which makes no sense for investors. So I'm looking for the global economy to do better than is widely anticipated. Commodity prices are already indicating that. We've seen that in copper. We've seen that in oil. We're seeing that in gold. And so stocks related to commodities of companies that produce commodities do make sense here. But so do industrial companies. So do cheap technology companies that have gotten beat up here quite hard. And financials look quite good. I understand that your banks are in better shape. Well, in the U.S., the U.S. banking system is in very good shape. So I think all in all, view the 2023 as a recovery year and invest along those lines.
All right, Ed, good to speak with you. Thank you very much for your time, and it's always a pleasure having you with us here.
My pleasure indeed. Thank you.